Let's say a company you've invested in has a fantastic year. I mean, they're just swimming in cash. So the big question is, how does that profit actually get from their bank account into yours? Well, it turns out there are two main ways they can do this, and you really got to know the difference. We're talking about dividends versus share buybacks.
Right. So the company's sitting on a pile of extra cash. Now they have a choice to make, and that choice has a direct impact on your wallet. Let's break down exactly what their options are.
It really boils down to two different paths they can take. Option 1, they can give you a direct cash payment. That's a dividend. Or option 2, they can try to make the slice of the company pie that you already own bigger and more valuable. And that is a share buyback.
All right, let's start with the classic, the most traditional route, the dividend. You can think of this as the company's most direct way of saying, hey, thanks for being a shareholder, here's your cut.
So what is a dividend, really?
Well, it's pretty much exactly what it sounds like. It's a chunk of the company's profit that gets paid directly into your brokerage account. It's usually cash, it's usually paid out every quarter, and it's about the most tangible reward you can get for owning a piece of the business.
So why do investors love dividends so much? Well, for starters, it's a predictable income stream. I mean, that's why retirees often build their entire portfolios around these things. But it's also a powerful signal. A company that pays a consistent dividend is basically broadcasting to the whole world that it's healthy, it's stable, and it's super confident about its future.
But hey, it's not a perfect system. Once a company starts paying dividends, Wall Street absolutely expects them to continue. Cutting that dividend, that's seen as a huge red flag and can totally tank the stock. And for you, those payments are taxed right away as income. But here's the big one. Every single dollar a company pays out to you is a dollar it's not putting back into the business to grow. That's a massive opportunity cost.
Okay, so what if a company wants to use that cash for a different kind of return? Well, that brings us to the other tool in their toolbox, the stock buyback. This isn't about sending you cash at all. It's about making the shares you already own more valuable. The way it works is actually pretty simple. The company takes its cash, goes out onto the stock market, and just starts buying its own stock, like any other investor would. Those shares they buy back are then basically taken out of circulation. Poof, they're gone. This reduces the total number of shares out there for everyone to buy and sell.
So why on earth would they do this? Just think about it for a second. If the company's total value stays exactly the same, but you divide that value among fewer shares, what happens? Well, each individual share that's left now represents a bigger piece of the ownership pie. Let me show you a really quick example. Let's say a company earns $100 in profit, and it has 100 shares out there. That gives it an earnings per share, or EPS, of exactly $1. Simple enough, right? Now watch this. What happens if that same company uses some cash to buy back 10 of its own shares? The profit is still $100, but now it's divided by only 90 shares. All of a sudden, the EPS jumps to $1.11. The company instantly looks more profitable on a per-share basis, and here's the kicker. It did it without earning a single extra dollar in actual profit. Now, the huge advantage for you, the investor, is taxes. With the buyback, you only pay tax when you decide to sell your shares, and even then, it's often at a lower capital gains rate. For the company, it's all about flexibility. They can start and stop buybacks whenever they want without causing a market meltdown. And, it sends a powerful message. Management is so confident they're buying their own stock. It screams, we think our stock is a bargain right now. But, of course, there are risks. Unlike a cash dividend, the return isn't a sure thing. The company is basically betting that by reducing the share count, the stock price will go up, but it might not. And if a company buys back its stock when the price is already high, it can end up just destroying shareholder value. It's like buying something for way more than it's worth.
And this, right here, is where buybacks get really controversial. Critics say they can be a kind of financial magic trick. By jacking up metrics like EPS, they can trigger massive bonuses for executives, even if the actual business hasn't gotten any better. The argument is that money could have, and maybe should have, gone into research and development, or higher wages for employees, things that create long-term growth.
Okay, so we've got two very different ways to get money back to shareholders. Let's put them head-to-head and see how they really stack up against each other. This is where you can really see the strategic trade-offs.
This table really cuts right to the chase. I mean, look, if a company wants maximum flexibility and wants to be super tax-friendly to its investors, buybacks have a clear edge. But they don't always send the right message. A dividend, that projects this image of unwavering stability. It says, we are a rock-solid business. A buyback, on the other hand, sends a more aggressive signal. We think our stock is cheap, and we're buying. And you can see how this splits investors, right? One is for people who want steady income. The other is more of a bet on future growth.
So this all leads us to the one big question we've been building up to. After weighing all the pros and cons, which one is actually better for you?
And the honest truth is, there's no single winner here. The right answer isn't about which one is universally better. It's about which one is right for a specific company at a specific point in time. A young, growing tech company might lean towards buybacks for the flexibility, while a big, mature utility company might choose dividends for the stability it signals. Your job as an investor is to figure out which strategy lines up with your own goals.
Because ultimately, it all comes down to a fundamental choice about what kind of investor you are. Are you looking for that guaranteed check in the mail right now? Or are you willing to pass on that immediate cash for the potential of a bigger payoff down the road as your ownership stake gets bigger? The answer to that question will tell you everything you need to know about whether you're on Team Dividend or Team Buyback.